Good afternoon and welcome to today's Green Talk Live, to those of you in the room and to those of you online. My name is Anthony Cox and I'm the Deputy Director for the Environment Directorate at OECD. And earlier today, the OECD released a major new report, Taxing Energy Use 2019, Using Taxes for Climate Action. A copy of the report here. Today, Jonas Teusch from the Centre for Tax Policy and Administration, who's been leading our work in this area, will present some of the highlights from this new report. Where do countries stand in deploying energy and carbon taxes to reach environmental and climate goals? How can countries step up efforts? Questions like that, and we'll know the answers shortly. Taxing Energy Use 2019 is the result of a close collaboration between the Centre for Tax Policy and the Environment Directorate. It's overseen within the OECD structure by the joint meetings of tax and environment experts, which is a body where delegates from tax and environment ministries work together on issues that cut across the tax and environment policy agenda. The presentation will last for about 20 minutes and the talk will be followed by Q&A both from those who are in the room here and importantly online. We're really interested in getting your views on the findings, including on what can be done to improve policy going forward. I invite you to submit questions both during and after the talk. I'll give the floor to Jonas in a minute, but for those of you online, you can send questions at any time to web host in the chat section of your WebEx screen, and I will convey them to Jonas. So this is your chance to dig deeper into the subject. So without further ado, I'll hand over to you, Jonas.
Thank you very much, Anthony. Yes, let me share some highlights from the report with you. As you're tuned in, you probably agree that climate action is urgent. And we also know that keeping climate change at bay in line with the goals of the Paris Agreement will require deep cuts in emissions. Increasing public pressure for governments to do more on climate change, and it's also increasing awareness that the costs and consequences of inaction are large. Yet, just last year, we reached a new record high in terms of energy-related CO2 emissions. There's certainly scope for more action. This talk is about taxes on energy use. So what contribution do we think energy and carbon taxes can actually make in curbing climate change, in slowing this trend of rising emissions? Economies, consumption and production decisions are guided by prices, among other factors. And if prices reflect the costs of environmental costs of goods and services, then consumers and producers will make cleaner choices. Concrete example how taxes can help there. If taxes provide this price signal, for instance in the power sector, then the production decisions will be different. In the power sector, for instance, there could be the situation where you could either meet demand by using an existing coal-fired power plant or existing gas-fired power plant. In the absence of carbon price signal, it would typically or often be cheaper to use the coal-fired power plant that's already there. But if there is a carbon tax, then often the natural gas-fired power plant will be cheaper. In addition, if there's a carbon price signal, also means that investing zero carbon assets, such as wind and solar, will be more profitable. So we'll see more investments in these options. These are not mere theoretical properties. One example, there are many, but one example would be the UK, which in 2013 introduced a carbon price floor for the power sector. It's now at 18 pounds sterling, roughly. And this essentially means that it's more and more economical to use natural gas and other cleaner sources than coal. And this year, in fact, there were more than 2 years where the UK did not need coal at all anymore in the power sector. So this is really something that has driven down emissions substantially in recent years. There are other goals of fiscal and tax policy than reducing CO2 emissions. It's also about raising revenues. It's about ensuring equity between different citizens and businesses. It's also about affordability of energy supplies and other products, and it's about competitiveness of the industry. But these are not mutually exclusive objectives, and we'll talk a bit about this later. Climate change is not the only environmental challenge. Another big one would be air pollution. But here again, actually, taxing energy use in a smart way can contribute to meeting this challenge as well. So there could be a co-benefit of also reduced local air pollution. To give you the main results before I go into the details. Very simply, taxes are nowhere near their full potential to reduce the risks and impacts of climate change and air pollution. Here in this report, we study 44 OECD and G20 economies, and we find that 70% of energy-related CO2 emissions are not taxed at all. And overall, we conclude that energy tax systems do not provide enough incentives to move to cleaner energy sources. We also point to policy reforms that could improve environmental and climate outcomes, but also actually make the overall system more equal, promote well-being, make economies competitive, fit for the future, and also policy option that would improve tax policy more broadly. Stress that taxing fuels is not the only way to price carbon. Jurisdiction can and do use emissions trading systems and related instruments to effectively price carbon. When you use an emissions trading systems, you don't directly price carbon, but you cap the emissions, and this results in a carbon price. There are some important examples. One would be the EU ETS, which recently has seen much higher prices, and California and Quebec are other examples. So these can also be very effective and very efficient, very similar also for a carbon tax, for instance. And we look at these in a separate report, which is called Effective Carbon Rates, which came out last year. And we'll also update this report again soon. However, the overall message doesn't change. So even if we broaden the scope, we still find that overall the carbon price signals are not sufficient. So a related policy issue of fossil fuel subsidies, and we have very detailed data on this as well at the OECD in the tree of support measures for fossil fuels. So this is also in a separate publication. Turn to taxing energy use, because that's what we're here for today. It's not the first time we released this report. We first released it in 2013. Back then, we were focusing on energy and carbon taxes in OECD countries only. We've then extended it to include G20 economies in 2015. Back then, tax rates were for 2012. Then in 2018, just last year, we updated tax rates to 2015. And now this year, we update them to 2018. So we're getting closer and closer to real time. And maybe next time we'll predict tax rates. Scope of this edition. We compare tax-based carbon price signals against the low-end carbon price benchmark. That's one part of the report. What do we mean by low-end carbon price benchmark? Here, Euro 30 per ton of CO2. This is not to say that we think this is sufficient to steer our economies on a low carbon growth path to meet the objectives of the goals of the Paris Agreement. But we think if you have a carbon price in place that's less than this, this is certainly not sufficient. So it's really like a very conservative low-end estimate. It doesn't mean that that this is enough. But we don't only focus on carbon pricing here broadly understood. This means in a second. But we also look at taxes on energy use more broadly. So also including taxes on clean sources, including implicit taxes or wind and solar. And this is the final slide of the presentation. We go into quite a lot of detail in the report and also a little bit in the presentation. So you can find tax rates and tax bases, country, sector, energy category. So if you're interested, feel free to dig in. Let me give you like the headline results now by fuel. Here we show essentially average tax rates for the 44 countries we cover, and the big message is overall taxes are not being used to provide a meaningful carbon price signal. Let me explain a little what we do here. First, you will see that we don't only, when we talk about carbon price signals, we don't only look at taxes that are called carbon taxes. So carbon taxes are typically explicitly motivated by the desire to reduce CO2 emissions. But there are similar, economically very similar instruments called fuel excise taxes, which have been in place for a long time, were mostly introduced simply to raise revenue. But these also apply specifically to polluting fuels and make using these fuels more expensive. So they're economically very similar. So what we do, we actually look at these and explicit carbon taxes, and then the sum of these two we call the effective carbon tax rate. Look at one fuel that's the most used fuel among the fossil fuels is coal. Here you see that the average effective carbon tax rate is actually less than €1 per ton of CO2. I mentioned earlier what we consider low-end price benchmark would be Euro 30, so we are very far away from this low-end benchmark here. Also interesting to note is the relative contribution of fuel excise and carbon taxes. Reading the news, one may conclude that carbon taxes are clearly the main instrument, but still today, price signals largely stem from fuel excise taxes. I think it's important to stress that because when we discuss carbon tax reform, it's often perceived as something really new that we haven't had before, but actually they are very similar to fuel excise taxes, which we have for many decades or even hundreds of years in some cases. So we would like to stress that it's something we have been dealing with for a long time, and also reforming the tax system to better align taxes with the pollution profile of energy sources is something that will probably or should involve also looking at pre-existing taxes. Let's look at move from fuels to sectors. Essentially what we find is that outside road transport, the bulk of carbon emissions are completely unpriced. So again, reading the news, one often has the impression that most emissions come from road transport, or sometimes one may get the impression. Certainly a very important sector to decarbonize, 15% roughly of emissions, but it's not the only sector. So overall, most emissions come from different sectors: electricity generation, manufacturing, heating, and also aviation and maritime transport. So let's look at these non-road emissions. And there we see that 82% are actually completely untaxed. What I hadn't shown so much previously was the fact that among the fuels here, there are two fuels that are actually taxed at a higher rate than this low-end benchmark, which is diesel and gasoline. The reason is that these are mainly used in road transport, and there we actually do see higher taxes. But there are also good reasons for these higher taxes. In road transport, external costs are very high, for instance, also local air pollution, congestion, and even from a climate perspective, of course, this is still would still make sense to have higher tax rates. And then in addition, there may be revenue raising considerations and other considerations to have higher tax rates. So just to make this clear, I will return now to the next slide. We then look at per country level in the non-road sector, and we find that only 4 of the 44 countries we have, tax non-road emissions at more than Euro 30 per ton. As I mentioned before, that there are of course also other instruments, especially emissions trading systems. So we don't look at the full picture here. And especially these 4 countries additionally also participate in emissions trading systems. They have actually stronger carbon price signals. And we also look at, for the first time in this report, emissions from international aviation and maritime transport, which are not taxed at all. And there's emissions trading systems apply in the EU. Flights within the European Union are included in the emissions trading system. There's some price signal there. We also look at fuels used in domestic aviation, which in large countries is actually a sizable energy user, and these are sometimes taxed, for instance, also in Japan. Special about taxes compared to some of the other climate policy instruments we're discussing, that fuel economy standards, is that taxes raise revenues. When we think about the distributional impacts of the use of this policy instrument, it's important to also consider how the revenues are used. If we think about the policy package, we introduce a carbon tax or fuel excise tax. We then have revenues at our disposal, and we can use these revenues to make the reform progressive. We may have a very simple back of the envelope estimate here. If we were to increase effective carbon tax rates to Euro 30 per ton, across all countries covered, we would roughly raise 1% additional tax revenues. So these could be used, for instance, to ease the transition for vulnerable groups. Then I would like to move to one a bit more technical slide. We took fuel excise taxes, explicit carbon taxes together, but of course much of the discussion on reform is on introducing taxes explicitly for climate reasons. And so let's look at the explicit carbon taxes. This chart shows you all jurisdictions in our sample that had explicit carbon taxes in place as of last year. And the orange dot shows you the headline rate. So that's what you typically use, is the price per ton of CO2. See that Sweden has the highest explicit carbon tax rate, followed by Switzerland. What we also look at in this report always is not only the rate, but also the corresponding base. And that essentially is shown a bit with the gray bar. It's the average rate that applies across all combustion emissions in the country. So what you see with this graph, what it shows you that actually explicit carbon taxes don't cover all emissions either. So it's not like in a textbook. But there are straightforward reasons for this. One is that typically when countries also have an emissions trading system, they decide to only use one lead instrument. So they will, most countries will then essentially exempt facilities that already pay a permit price as part of the trading system from paying the carbon tax. Another reason also, in the base, we also have emissions from the combustion of biofuels because we use a combustion approach, but these are typically not taxed because most countries focus their explicit carbon taxes on fossil fuels. There are also less straightforward reasons for why the coverage is never 100%. Some countries don't actually apply carbon taxes to all fossil fuels. So for instance, some countries like Mexico would say natural gas is the cleanest fossil fuel, let's not apply the carbon tax to natural gas. Other countries would exclude coal, which is generally the most polluting fuel. That's, for instance, the case in Iceland, but they have very little coal use, one should also add. And then finally, of course, not all users are often subject to paying the tax. So there may be exemptions for certain users for different reasons, say for competitiveness or affordability issues. But they generally would say that we better targeted instruments to deal with this, because once you give a user an exemption, you lose essentially the incentive effect. So then this user no longer has the incentive to reduce emissions. But if you keep the tax and then find some other way to deal with the competitiveness concern, you keep the emission reduction incentives in place. So I want to talk about was, because we talk a lot about this Euro 30 carbon benchmark, what does it actually mean in practice? Because when we purchase fuels, we don't typically purchase them, or actually we never purchase them per ton of CO2. So we purchase them in different units. So for instance, for gasoline, a Euro 30 benchmark would roughly correspond to 7 cents per liter. For coal, it would be, say here, 6 cents per kilogram, euro cents in any case. So this allows you to give you a better feeling of what it actually means in practice. I already mentioned at the beginning that we don't only look at combustible fuels, we also look at energy sources more broadly. And one thing we can see now when we look at all energy use in the countries we cover, we now move to gigajoule from CO2 because we also want to have a measure of non-combustibles. Countries also tax electricity. So they don't only tax fuels, but also tax electricity. Typically, these taxes are not differentiated by fuel, so they would apply to all electricity, irrespective of where it comes from. And so even if you, say, produce electricity from a clean source, such as hydropower, you still have to pay the electricity tax. This doesn't provide direct incentives for producers to shift to cleaner fuels. And in addition, if you think about this from a more cross-sectoral perspective, it makes electricity more expensive, so it could slow down, say, electrification of other sectors. For instance, in road transport, one way to decarbonize road transport is to move to electric vehicles, so you may sometimes slow down this, right? Of course, there are many important reasons for electricity taxes as well from a fiscal perspective. Often they are an important part of government revenue, so thinking about reform will also have to involve these considerations, but from a pure climate angle, there would be more targeted instruments available. Takeaways, first, as I mentioned at the beginning, generally there's room to strengthen carbon prices, and that would help consumers and producers to make cleaner choices and move us further towards achieving the goals of the Paris Agreement. Then we also pointed to a couple of fuels and sectors that are at present hardly taxed at all. It could make sense to start raising prices where they're currently lowest. You would actually get emission reductions per euro of tax increase there, standard assumptions. And finally, as mentioned, there may also be some scope for better targeting certain taxes, for instance, electricity taxes, to strengthen the potential to reduce emissions there. I've gone through the report in, I think, roughly 20 minutes, as I was told. And now we have time to actually answer questions you may have. But before doing that, I will give the floor back to Anthony. Yeah, one last slide where I will just, as you already know, there is a report, and you can read up on more on the things I mentioned in the report. What we also have in the report are country tax profiles, meaning you can have a look at how your country taxes energy use across all sectors. Also, we also distinguish between different fuels, so that could be interesting. And we provide additional details. If you really want to know how taxes apply across sectors and fuels, have a look also at the online country notes. The link is there. It's OECD/TEU 2019. Now I give the floor back to Anthony.
Jonas, and I would strongly encourage everyone to get into the website and to have a look at the country detail. It really is a very rich source of information and data. I just wanted to complement Jonas's presentation by making the link to the broader climate debate. It's clear that reform is necessary, is absolutely necessary to help drive strong climate action. But to make such reform a success, we really do need to be aware of the impact that energy and carbon taxation has on people's lives and on people's. And this is where a recent report that was released by the OECD called Accelerating Climate Action, Refocusing Policy Through a Wellbeing Lens comes into play. Now, this report focuses on how governments can achieve goals like cleaner air, healthy eating, accessibility of services and employment, and inclusive fiscal reform, how focusing on those goals can make it easier to implement changes that are also going to affect climate. The decisions on how revenue is spent will make it or harder to sell those reforms to a public that is growing increasingly demanding of policy that are driving climate action. And what we've seen in the work so far is that decisions on revenue choices really differ between countries and over time. But that stronger integration between carbon pricing, between energy taxation, and between fiscal policies and more generally absolutely critical for helping to make climate action pay off when you marry it up with fiscal policy reform. This highlights the importance of the recently formed coalition of finance ministers for climate action, which is an initiative to which the OECD is lending active support. And this coalition is engaging fiscal communities with climate policy. So with that bridge made, I might now take the opportunity to open up the floor for questions. We've got quite a few questions coming in online, but in the meantime, I might, to kick things off, I might see if anyone from the floor in the room here would like to open up. So everyone's feeling that they've either had a... Oh, no, we do have a question. So, Daniel, could you please state your name and where you're from, and then your question?
I'm Daniel from Environment Directorate. I would have a quick question concerning the progress you are observing. So is there, so what is the rate of progress, let's say, between 2012, 2015, and 2018? So do we see that climate action is picking up, or is it more stagnating?
You could marry that up with a question that came in online, which is along the same lines, which is a more broader question. What is the future of carbon taxing? So let's have a look. Can you say something about the progress we've seen and what does the future hold?
Thank you very much for the question. Yeah. I think my microphone was off. Yes, now I'm back online. So in terms of progress, where we do see progress is with carbon taxes. One area for progress would be Latin America, where we see the implementation of carbon taxes, for instance, in Colombia, Argentina. And we also see some progress for instance, in the Nordic countries, sometimes phasing out exemptions. However, overall, we see relatively limited progress with carbon taxes. One related area we see some progress is emissions trading. So especially the trading prices in the EU ETS have really picked up. So we're now approaching this low-end carbon benchmark. So that's one area. And of course, if now China, the ETS comes online, this would also be really increased coverage by, at the beginning, roughly 10 percentage points. That would also make a big difference. Then there was a more general question on progress. Where are we going? With carbon taxes, I think it's important to clarify it doesn't have to be progress with carbon taxes. It could also be progress with emissions trading. So we don't have a preference for either one. If they're well designed, both can perfectly work. So I think if we want to achieve the objectives of the Paris Agreement, carbon taxes and carbon price more generally certainly has an important role to play. It's not the only instrument that's going to make us reach these objectives, but it certainly a very effective instrument and cost-effective instrument because it leaves it up to the energy user to reduce emissions. And the energy user will know best when and how to reduce emissions. So it doesn't require governments to know exactly where the emission reductions will come from, but it will actually really innovation and relies on the ingenuity of entrepreneurs and people in the economy. So I think that's why it's a very effective tool, and I do see a lot of potential there. But as you said before, it's very important when you do design a reform to really think about the distributional impacts. And that's why thinking about the revenue use, clearly communicating on the revenue use are certainly important elements for a reform package that works in practice.
So that link to revenue use actually echoes many of the questions that are coming in online. So before we go to our next question from the floor here, perhaps you could just enlarge a little on what is the evidence around the OECD at least on how those revenues, those carbon pricing revenues and the energy taxation revenues are being used. You mentioned at the outset that energy taxes are often instituted for revenue raising purposes, but the political economy really means that you have to pay a lot of attention to how you're going to use carbon revenues on top of that. So what's the evidence so far?
Actually a working paper by colleagues of mine, Kurt van den and Melanie Martin, where they really look at revenue use in detail. It's important to distinguish between the two components here when we talk about revenue. I mentioned we look at fuel excise taxes and explicit carbon taxes. Fuel excise taxes are much more commonly simply go to the general budget. There are no constraints on the revenue use. They may sometimes be earmarked for specific transport purposes. It's more common that there is a specific communication and sometimes even a legal constraint. I could actually give the question to my colleague who wrote the paper, who I think could go into greater detail.
Some more detail, not too much, Kurt, because we have a number of other questions that we'd like to address.
Yeah, so very briefly then. So indeed, we published that paper. It's online as a tax policy working paper on the OECD website. It's published in June of this year, actually, called On the Revenues from Revenue Use from Carbon Pricing. It looks at three things. It looks at taxes, so excise taxes and carbon taxes. It also looks at how the revenue from emissions trading systems is being used. Finds large differences, as Jonas already explained, between these three components. And the remarkable thing is that the carbon tax story is very much a story of environmental fiscal reform. So there we really have a notion of using the revenues in a way that interacts with broader tax policy, which then can become a story of indeed distributional objectives, improving the efficiency of the tax system. This is quite different, notably, from what happens with emissions, with revenue from trading systems, where there very often there's a very close link with green spending, climate spending, green investments. That's kind of a different choice. And as you have highlighted already, Anthony, I think there's a growing awareness that if we're going to go for ambitious carbon pricing, then of course we should think about climate spending, but we also should think about connections with broad tax policy that can, improve buy-in, that perhaps give specific attention to the lower incomes, and that way improve the acceptance of carbon pricing. There's a lot of discussion of these things these days. There seems to be a lot of hope that good decisions on revenue use can improve acceptance for carbon pricing. Maybe there's a bit too much hope and optimism that good revenue choices in themselves can make the case for carbon pricing. That maybe is a bit too strong, but nevertheless, it's very good news, I think, that the revenue use discussion itself is at the core of carbon pricing reform today. One thing that tends to get forgotten there is that the revenue use discussion is about explicit revenue use. So money that actually makes it to the government budget. There are a lot of reduced rates. There's a lot of free permit allocation with emission trading systems. That is foregone revenue for the government, which at the same time also reduces the effectiveness of the carbon pricing signal. So we should discuss revenue use, but we should also discuss implicit revenue use and look for good design of carbon pricing systems in that sense too.
And indeed, foregone revenue has a distributional impact as well. So that's a very important dimension to remember. We have a question from the floor, please.
Hello, my name is Aditya. I'm from DCD. I think one of the points that you raised was that you're also interested in taxing energy from renewable sources of energy. So I wanted to know how that aligns with the goals of the Paris Agreement.
Thank you very much. Interested that, in a way that we show how these are being taxed, but from a climate perspective, the focus should be on taxing polluting fuels. So we show in this report how certain taxes, electricity taxes, sometimes also apply to these clean forms of energy. But interest just in terms of showing the issue and potentially encouraging reform from a climate perspective. This is the interest. It wasn't a recommendation that one should tax clean sources necessarily, at least not from a climate perspective.
So we have a whole range of questions online, pages and pages, in fact, and we're not going to get to them all, but I'd just like to pick up on one here that is from Sabrine Boudjemaline, who asked, does the report give some insights on the impact of taxes on the employment market? This is a very important question for the political economy, actually. We talked about revenue use, but how about going the next step?
I fully agree that's a very important question. This particular report focuses on diagnosis. It looks where taxes stand at the moment. The focus of this report is not on analyzing these impacts in detail, but there's of course other OECD work. There are many working papers where we look at impacts, for instance, of the EU emissions trading system on competitiveness and other issues. So in this report, it's more of a data-driven diagnosis, but there are other work that would deal with the issue. But it's a narrow report in the sense we focus on what we can actually do.
In fact, there is work underway in the OECD to look at the links between climate action, full range of climate action, including carbon pricing and employment impacts. So it's a very challenging area to be working in because of issues around data. That's a big one. One more question online before we take one from the floor. A good question here that has there been a comparative study on fossil fuel subsidies and carbon taxes? Is there better scope for reducing fossil fuel subsidies than increasing the taxes? So we just happen to have our fossil fuel subsidy expert in the room. So maybe Jonas and Asia can provide a joint answer on that one.
Sounds good. I'll start. Just maybe as a clarification to explain a bit the overlap actually already between the two publications, because one element of fossil fuel subsidies are also a thing called tax expenditures. So there are countries that have reduced rates for certain energy users. For instance, in the EU, some countries have a reduction for commercial diesel use in road transport. And they then often report this as a tax expenditure. And this would be counted as a subsidy in the inventory. And in our case, would simply be reduced rate. So it's covered in both reports. So there's this overlap. And then there are some other forms of subsidies, such as direct price support, which in this report are not covered, but we're also working on extending our work to in the future be able to, at least for a selected number of countries, cover these forms of subsidies as well. Now I will pass.
Asia, do you want to say a few words about the fossil fuel subsidies? So Asia, if you could introduce yourself and say a few words about the fossil fuel subsidies. And maybe you want to speculate, is it easier to reform fossil fuel subsidies or to increase carbon prices?
Okay, so I am Asia Alguasam. I work on the fossil fuel subsidies and their reform in the OECD. We have an inventory that tracks individual policies that are that confer benefit to consumers and producers. This includes budgetary transfers, so direct cash transfers to either producers, consumers, the tax expenditures that are integrated in the taxing energy use work, and also induced transfers and other components of support. On the fossil fuel subsidy reform and how we can, when it could be a case of like a low-hanging fruit for reform, there are of course many countries that are that regulate prices, and so that domestic prices are not tracking market prices, and we see that when countries decide to reform these kind of regulations, there is a huge backlash, as we see currently in Ecuador. Ecuador has gone back on its fossil fuel subsidy reform. Of course, in this area, slow and frequent changes to prices are better than sudden increases in prices. Also, we see in our member countries, there's a lot of spending through the tax code. So all these tax expenditures, and I think the recommendation from the taxing energy use work to begin where the taxes are lowest and where the tax breaks are most prevalent to as areas for reform. And that would be it.
Is we have to do both, of course. So, Andrew, question, please.
Thanks a lot. Andrew Prague from the Environment Directorate, although recently returned from 2 years at the IEA, where I was head of the Environment Climate Unit there. I guess I'm sitting in a position that's making... great presentation, and really interesting to see the electricity taxes on the same axis as excise duty and other explicit carbon taxes. And I was wondering what your perspective is on electric transport. So if there's some of the projections you see for the rapid uptake of electric vehicles pan out, then at some point that reduction in consumption is going to materially impact the revenues from excise duty. So is it inevitable that countries turn to electricity taxes to make up the shortfall with the environmental implications of that? Or do you recommend other means of road use or other means that don't involve taxing electricity from electric vehicles?
Yeah, thanks a lot for the question. That's actually something we also discuss in chapter 2 of the report. So that's certainly a concern among some policymakers. what we, first of all, even if we rely strongly on carbon taxes, at constant rates, you're right, revenues would decline. But there's also, if one continues to rely on these carbon taxes to drive emission reductions, rates may actually increase as well. So we may be talking about relatively constant revenues for more than a decade, maybe 20 years, even longer. So they won't break away immediately. And the more forward-looking element is, well, in the future, should we tax electricity? And that's fundamentally, it's a larger tax policy discussion of where do you want to tax, right? So in an ideal world, we would look at all tax bases that are out there and try to find the one that distorts the least and is the least harmful to growth. So broader discussion of what's a good tax base, and it's not entirely clear that you would want to tax electricity if there are no negative externalities associated with the use from an environmental perspective. This is a bit the point we look at the report. Well, how high are the external costs? And from an external cost pricing or taxing perspective, then there's not necessarily a need for a tax. But there could be other revenue-raising motivations. And these should ideally be discussed as in a broader debate. If there are concerns that revenues will break away too quickly, one could, of course, say, fully phase in carbon taxes and say, well, if these revenues go away, then we eventually maybe do a reform and reconsider raising them again. But ideally, always with this in mind that let's have a closer look at the good tax basis.
Please.
Thank you. Stefan Weidens from the Consumption Taxes Unit at CTP. Things are discussed and done apparently on taxing consumption of carbon-emitting products. What about taxing their production? Like, for example, mining taxes. Also, of course, influence the prices at the end.
We do not look at upstream taxes in this report, but there's certainly, well, it would be nice to cover them as well. We take a sort of manageable approach and look at tax on energy use, where we know the externalities quite well. At least the climate externality is fairly straightforward to calculate for fuel combustion, but there's always scope to extend the approach if.
Actually, that's a very good point, but and it's a nice opportunity for me to advertise a forthcoming Green Growth Sustainable Development Forum event that'll be held at the OECD at the end of November, which is focused on the heavy industries and the fiscal implications of the low carbon transition for that sector. And that's where we spend 1.5 days and bring together experts from those industries, from those sectors, fiscal experts, as well as climate policy people together. So keep an eye out for that. You'll find it on the OECD website. Some more questions online. There's a whole raft of questions, Jonas, that take you a little bit beyond the scope of your report, but I think it's worth delving into, and that relates to the, and we've touched on this a bit, but that relates to the social impacts of these energy taxes. And one of the typical questions here is, what about the social impacts, the poorest segment of the population? What are your proposals to best avoid undue hardship, fears, and in consequence, violent reactions like the Gilets jaunes here in Paris, and more recently, the unrest in Ecuador? What are the OECD's favourite instruments to try and ameliorate these adverse impacts?
Pertinent policy question. I mean, one thing we do raise in the report, and we have also a working paper on energy tax and affordability, is what I already mentioned, that given that these taxes raise revenues and that typically more affluent households, richer households consume more polluting fuels, there is the scope for recycling these revenues in a way that turns these tax reforms into progressive tax reforms. In terms of favorite instruments, I mean, the best instruments to deal with this will always depend on the local circumstances. I don't think there's one policy instrument, but what we generally recommend is carefully consider which instruments work in your country context, and we often say targeted compensation can be a good idea. Really try to use the revenues, which are government revenues, are often scarce, and use these to target those that are most in need.
Thank you. Other questions from the floor here? Well, let's go back to the online questions. There was a specific point that you raised in your presentation around aviation, and a question came in: how do we manage, or how do you take into account these exemptions that are like free permits that are issued under or free allocations under the various trading schemes that are out there, and the exemptions for aviation? I know you've done some work in the report on the aviation sector. What's the findings there?
Yes, so in the report, we only look at taxes, so we don't look at emissions trading systems. We show that international aviation is not subject to any fuel tax or any emissions-based carbon tax either. Of course, as I also mentioned in the presentation, in the European Union, domestic flights within the European economic area are subject to EU ETS, but this is not covered in this report. So this is something we will hopefully cover in the next edition of Effective Carbon Rates, which is our companion publication where we look at these emissions trading systems. When it comes to domestic aviation, there we would account for the fact that most European countries, for instance, don't tax fuels for this purpose. So these things would be accounted for.
Thank you. The other question, which was related to the distributional question domestically, is this issue of we focused in your report very much on OECD countries, and you've indicated that while it's not high amounts of tax in most of the countries, and most of the emissions are not taxed, some emissions are taxed, and some of them are taxed quite highly. The question that's coming in from a few viewers online is this shifting production from OECD countries to non-OECD countries? Are we just shifting the burden? Are we seeing any evidence of that?
Just to clarify, we cover OECD and G20s, and actually G20 members, some of them are very large energy users. So in our weighted averages, these play a very important role. So it's not only OECD. Competitiveness, I guess there's a short-term dimension and a long-term dimension. The short-term competitive impacts, there are now exposed studies looking at the impacts of existing carbon pricing schemes on competitiveness. Actually, most find that there is no measurable negative impact on competitiveness. There's an OECD review already from 2015. There are more recent working papers, so there's more research you could look into. So at least at these present relatively low levels, there's very little, if any, evidence for negative competitive impacts. If there are, they are typically impacts that will be rather for smaller groups, and there are ways to address these. Moving forward, if we're thinking of moving to an economy that's essentially carbon neutral by mid-century, then competitiveness is a different thing. If you're a company and you use carbon-intensive sources of production, you will no longer be competitive in the future. So imposing maybe relatively low carbon taxes now that may increase in the future actually helps adapt to the new reality and make the right choices, so we don't end up with stranded assets, investments in brown assets that will later lose value. So I think actually the smart carbon pricing strategy is perfectly aligned with competitiveness, and we don't see any major impacts on carbon leakage or relocation with carbon prices.
Question is about carbon entanglement, and this may be something that we can bring some of our from the Centre for Tax Policy in on as well, who I know have been doing work on this. Carbon entanglement really is how government revenues are very much dependent on revenues from the fossil fuel sector. So do you see this carbon entanglement as an issue as we start to make the low carbon transition? We lose revenues from fossil fuels. not being replaced by from revenues from cleaner sources of energy. So is this going to be an issue for government tax schemes in the future, this fiscal sustainability? I don't know if you want to answer this, Jonas, or Kurt might want to jump in as well. We can both have a go.
I'll jump in because we did report on this question actually precisely for Slovenia a while ago, where the question indeed is, that's all related to what Andrew brought up earlier. Evolution, electrification of the vehicle fleet, we're going to be consuming less fossil fuels, hopefully, and then this will erode that tax base in that sector. What do we do? I mean, the background question is, will ministries of finance become very nervous that they're going to be losing revenue from that sector and therefore maybe be a bit less enthusiastic about a very fast low carbon transition? Our analysis shows, I mean, you could indeed think about electricity taxes to replace that revenue. We think it's more productive, as Jonas also indicated, transport sector about moving to distance-based charges. There's lots of external costs in the transport sector. Some of them are closely related to fuel consumption. Most of them are actually closely related to driving. So if we're going to be using driving-based charges, then at the same time we can address externalities better than we currently do, and we can replace that revenue base in the transport sector. If we would want to do that, we can also look for other sources of revenue or raise less revenue. That's also a potential choice, of course. But so the message is quite important. We don't necessarily think we know that a lot of countries are a bit worried about maybe moving away from electricity charges and using these charges more to tax the heavily carbon intensive fuels more strongly. We think this is something that could be considered. We also think, therefore, in the transport that moving to other revenue bases than electricity, more generally not relying so much more on taxing transport energy, but actually taxing transport services, that would be the way to go in the future. Now, these evolutions are slow, so we have time to adapt. We're a bit concerned sometimes that countries don't care enough and don't start preparing early enough. They do worry about lost revenues from subsidies to electric vehicles, which exist in a lot of countries, also not covered in taxing energy use, but it's a tax policy which is being used to stimulate electrification. That has large revenue impacts, and there too we think that moving to the distance-based charges approach would be a solution for that revenue gap.
And of course, this is on the agenda for the Coalition for Finance Ministers for Climate Action. So it's good to see that the finance ministers are really taking this very seriously indeed. Are there questions from the floor here? If not, we'll go to some questions on a question online here, which, oh, I've lost the place here, just a minute. Is about does the Euro 30 price of carbon account for the subsidies? And I assume that's for the subsidies that are given in terms of the support to the fossil fuel sector.
Well, the Euro 30 price benchmark here is really a benchmark against which we compare the taxes as they apply in the country. So they, as I mentioned before, subsidies are only covered insofar as they take the form of tax expenditures for energy use, reduced rates for energy use. Otherwise, they're not covered here. And the benchmark, well, it's price benchmark based on a literature review we did a couple of years ago. It's meant to essentially be a low-end estimate of total cost of carbon or what other kind of carbon prices we need to make progress with reducing emissions.
That's the low end of the environmental externalities associated with fossil fuel use.
Yes.
We have time for one more question, maybe two more questions. A rather provocative question here, and doesn't hurt to have the odd provocative question. Don't you think that such an additional tax pressure from increasing carbon taxes will push countries once again into economic recession? So this is, apart from the very normative question there, but isn't this a question about how much scope is there, do we think, for increasing carbon taxes in the energy sector and in the economy more broadly?
I'd like to go back to one of the things I mentioned at the very beginning of my talk was this divide between fuel excise and carbon taxes. And we have been levying fuel excise taxes for a very long time, and they're still much, much higher than carbon taxes, and we haven't had recessions every year. So I don't think that now more closely aligning the energy tax system with the external costs would lead to a recession.
Very sound answer, I think. So one last question, and also a little provocative, and going beyond the energy taxation directly, but into a more cross-border issue, and this relates to border carbon adjustments. This is a topic that keeps coming up in the discussions, and I know it's a hot debate in groups such as the EU and elsewhere. So have we done any work in the Centre for Tax Policy on this issue?
That question to my head of unit.
Thank you. Well done. The answer to your question is we have not recently worked on border carbon adjustments in the Centre for Tax Policy, or I think anywhere in the OECD. But you're right, of course, that the topic is under discussion. It is and will always be extremely controversial. Something that if a jurisdiction or a set of jurisdictions are going to increase the price of carbon, then it would only be natural that the same, same burden is imposed on those that are trying to import into that jurisdiction. I think that avoiding carbon leakage is an important objective of border carbon adjustments. But as Jonas has explained, the evidence for carbon leakage is that it's limited. That's the problem that we need to solve. There maybe is not that big of a problem to solve, and therefore, in that sense, border carbon adjustments might not be, that much of a priority, despite what, at first sight, one might consider. Now, if BCA's border carbon adjustments are going to be compensation for competitiveness risk, then of course we should consider that the design of current systems already often offers some protection for competitiveness risks. So in a sense, it's one or the other. So if we're going to be introducing BCAs, which is going to be very difficult, do we at the same time then think about removing free permits? Or do we think about removing preferential rates? To put the discussion in these kinds of terms, how do we do it? Then it starts to sound differently, and maybe this at first sight strong case for BCAs becomes a bit weaker. But these are just thoughts. As said, we haven't studied it in any depth recently, but these would be lines along which I would expect the debate to be organized.
Thank you, Kurt. And indeed, any discussion around border carbon adjustments does need to be put into a much broader context of the whole tax and border protection. So I suspect it will be a live debate sooner rather than later, particularly if we head towards higher carbon taxes, as is advocated by a number of international organisations, including the IMF, with a very strong call in the last few days. So that is all the time we have for today. I'd like to thank Jonas very much for the presentation, and congratulations on the release of the report. And we look forward to hearing much more about it in the weeks to come, and using it to help drive stronger climate action. So thanks very much. For those of us online, here are the. I would encourage you to tune in for our next Green Talks Live. We have Up next, on the 14th of November, we have Green Talk Live on pharmaceutical residues in freshwater, that is looking at the hazards and possible policy responses. Then on the 22nd of November, scaling up climate compatible infrastructure, insights from national development banks in Brazil and South Africa. And then on the 10th of December, in the middle of COP25, we have a Green Talk on aligning policies in the land use nexus. You can get more information on these Green Talks from our website. So thank you very much for those in the room, and thank you very much online, and we'll look forward to seeing you at the next Green Talk Live.